Michael Burry is famous for correctly predicting the greatest economic recession of all time, as portrayed by Christian Bale in The Big Short. But Burry has also correctly predicted every last major stock market crash, from the dot-com collapse of the early 2000s to the housing collapse of 2007. And he even predicted the latest runaway inflation and falling stock prices that we're seeing today. Seriously, somebody tell this guy to go to Vegas. But lately, Burry's been warning about a new economic crisis brewing in the markets, one which he claims the US government itself is trying to keep under wraps out of fear of provoking a nationwide panic. So in this video, we'll be looking at what has Michael Burry saying this could be worse than the Great Recession in 2008. Talk through why Burry, along with several prominent CEOs, are terrified the Fed is pushing us toward a total financial meltdown. And we'll go over the exact stock strategy that Burry is following to continue to make money even if we enter an even worse recession than in 2008. And if you find anything valuable in this video, just let me know in the comments. I'm trying to get back into a regular schedule, and your comments really do matter a lot. So Burry may have first become famous for his big short of the housing market in 2007, where he personally profited $100 million after his bet against the housing market ultimately paid off. But that wasn't Burry's only crazy prediction. He must have a crystal ball hidden somewhere in his house, because he first made a name for himself on Wall Street during the early 2000s, when he correctly predicted and shorted the dot-com bubble in tech stocks. He later reportedly made a 1,500% return on GameStop during the early days of that stock's rise. And more recently, he completely sold out of the market just prior to the most recent correction, potentially saving hundreds of millions of dollars. And Burry is now warning the general public that we are in a recession, and it's going to get a lot worse, especially for anyone who isn't prepared. Now, Burry is a very technical guy. He's actually a medical doctor by training, sort of like Doctor Strange if he got into investing instead of magic. And so when he makes technical posts like these, he tends to get ignored by most YouTubers in favor of his big, bold headline statements. But while this might look complicated, it's actually pretty simple when you break it down, and it's worth understanding. Because what he's predicting in this complicated looking tweet could be the difference between the economy recovering soon and us being stuck with runaway inflation and cratering stock prices for years to come. So if you haven't been living under a rock, you've probably noticed the huge amount of inflation in the economy. Everything from fuel prices to bread prices to restaurant chains have been getting more and more expensive as we exit the pandemic, which is honestly not a big surprise considering the Federal Reserve printed $4.5 trillion during the pandemic. I know that just sounds like a generic big number, but picture it this way. That's enough $1 bills where you could lay them flat on top of each other and they would stack up higher than Mount Everest, higher than the International Space Station, and would actually reach more than 12% of the way to the moon. This insane money printing has caused the amount of M2 money, or basically all cash and cash-like stuff in the economy, to balloon. We can see in this data from the Fed that there has been an exponential rise in the amount of money flowing in the system, which in general leads to more inflation. But that's only part of the equation when it comes to inflation. The other factor is known as the velocity of money, basically how often and how quickly dollars are being traded in the economy. In Burry's tweet, he includes a chart showing the velocity of money in the filled-in blue area, which we can see decreasing since the 1990s. While in the yellow line, we see M2 money supply increasing rapidly during that same period. But if we zoom in more, we see something super interesting. The M2 money supply has stopped growing and has even started to dip slightly on the top right of this chart. And it's even easier to see on this chart from the Federal Reserve, which shows the aggressive actions the Fed has taken to fight inflation, called quantitative tightening, seem to be working. Or at least, that's what everyone else thinks. But Burry points out that while the M2 money supply has dipped, which should act to fight inflation, the velocity of money has also increased. We can see it right there as a slight uptick on the bottom right side of the chart. This acts as a force increasing inflation. So we have two forces pushing against each other. M2 money supply dropping and thus lowering inflation, and the velocity of money increasing and thus raising inflation. So which one wins? Well, Burry points out that we had a similar situation in the 1970s. And in that situation, the velocity of money ended up being a more powerful force than the money supply. So if history repeats itself, we may continue to see inflation tick up higher and higher as the rising velocity of money overpowers any attempt by the Fed to reduce the M2 money supply. Not a great situation. But you know what would be great is if you share this video if you're finding it valuable. It really does help me out, and maybe you know someone who would like learning this stuff too. But the Federal Reserve is not going to let inflation just run away, because high inflation is very unpopular politically. Central banks around the world are going to be pressured to do something to combat it, which is where Burry, as well as several other CEOs such as JP Morgan's Daniel Del Pinto start getting worried, because they say the Fed is getting carried away and putting too much pressure on the economy in their bid to stop inflation. And if that pressure gets high enough, the entire thing could start to crack from the inside. It's no wonder then that Burry sold out of his stock positions when he saw this coming last year. But he's not the only one who's soured on stocks, because the average 60-40 portfolio of stocks and bonds is down a gut-wrenching 34% this year. It's the worst performance in a century, which is where this video's sponsor, Masterworks, comes into play. Money managers at places like Goldman Sachs and BlackRock are experiencing a historic shift where they're urging clients to invest less into the stock market and more into alternative assets. Goldman specifically calls out alternatives like precious metals and fine art. But why art? Well, because even with 2022's losses, Morgan Stanley reports that the average piece is selling for 26% more than it was this time last year. And the last time inflation was this high, art prices appreciated at an average of 17.5% per year, according to the Masterworks All Art Index. Masterworks offers shares in these multi-million-dollar artworks from legends like Picasso and Banksy, and they've delivered results, even in 2022. That's right, in early October, Masterworks exited a painting for an exceptional 21.5% net return to their investors. In fact, Masterworks has strategically exited 6 positions, each for a net return of over 20%. Now, Masterworks has been doing well, so there is a waitlist to sign up, but using my link in the description below, you can sign up for Masterworks today and completely skip the waitlist. So check out that link below, and okay, inflation is spiraling out of control and the Fed is doing everything they can to control it. But yes, we know inflation is painful for consumers, and it's definitely painful for politicians, hence the heavy focus on controlling it. But Burry is warning us that the cure might be more damaging than the cold in this case. Kind of like that cherry cough syrup my mom used to give me as a kid. No wonder they gave it to kids who couldn't read. Fed Chairman Jerome Powell even acknowledged that their actions at the Fed could throw the economy into a downturn in exchange for getting inflation closer to their goal. While President Joe Biden has argued the economy is strong enough to withstand continued downward pressure while the Fed tries to fight inflation, because that really is the core problem. Fighting inflation basically means slowing down the national economy. The Fed is really balancing between the two extremes. On one end is overly high inflation, and on the other is a massive potential recession. And if they tip too far to either side, it's a serious problem. But many CEOs think the Fed has already gone too far to one side, with 98% of CEOs preparing for a recession in the next 12 to 18 months. Burry, meanwhile, thinks we are already in a recession, and that it's just going to get a lot worse from here. And even the president of the largest bank in the world, JP Morgan, who actually supports fighting inflation, acknowledges that doing so will probably result in a recession and a dropping stock market, saying, "I think putting inflation back in a box is very important. If it causes a slightly deeper recession for a period of time, that is the price we have to pay." But if Burry's point about the velocity of money is true, that means the Fed may have to keep pushing for months before they are satisfied with current inflation numbers, even if we're in the depths of a recession at that point. And by then, who knows how bad the market may have gotten. But Burry isn't all doom and gloom, even if that is sort of his brand. I heard someone once say that he's predicted 30 of the last 5 market crashes, which is a little harsh, but it's definitely true that he's a pessimist 99% of the time. So it really stood out when I saw Burry tweet this a while back, saying, "I admit I'm feeling greedy." And while he walked that back a bit in later tweets, Burry has revealed exactly where he would invest to survive and even make money in the current economic environment. Burry specifically called out companies producing excess free cash flow as being ignored by the market right now, pointing out how if a company is producing lots of free cash flow, even if they have a lot of debt, it gives them options that most companies don't have. And just like when you're getting froyo toppings, more options is always a good thing. For example, let's say a company is producing $100 million in free cash flow each year, which is sort of like profit, but even more concrete, because profit can sometimes be a little intangible. So if a company is making $100 million a year, and let's say they have $100 million in debt, they could use that money they're making to pay off that debt, likely getting a big discount since interest rates have risen so much from where they used to be. That would be a great boost for the company because it makes them more secure and it cleans up their balance sheet. But on the flip side, if companies instead decided to use that excess cash to repurchase shares in their stock, that would directly contribute to the stock price of the company increasing. These companies with excess free cash flow could basically invest in themselves at rock bottom on prices. But whichever option the companies take, investors in those stocks end up winning, just because they have the power of options. And so Burry says investing in businesses with excess free cash flow is going to nearly always be a winning strategy, calling them statistical values, math problems that more or less must work out. So if you're intrigued by Burry's possibly intentionally vague tweets meant to make predictions without tying him down legally, here are some actual examples of companies with free cash flow. We have Apple, who produces nearly $100 billion in free cash flow per year and has a sizable cash position that they're sitting on. Though at a PE ratio of 25, they may not be considered cheap like Burry would prefer. Warren Buffett is a notable investor in this company. Geo Group is a company that produced over $200 million in free cash flow last year with a market cap of over $1 billion and a PE ratio of 16, making it a far cheaper company. It also happens to be the only stock that Burry bought in his most recent 13F filing with the SEC. And of course, if you wanted to find more stocks like this, you could always use a stock screener to generate hundreds of other stocks with low PE ratios and high cash flow. Here's just one screener I happened to Google, but there are lots out there. Now, I personally don't think Burry's advice is to just blindly buy every cash flowing business out there, and I definitely would not do that. I would take his advice as a starting point to get a list of potential investments, but then I'd still perform my regular due diligence to, one, make sure it's a solid business that I understand and that it isn't just going to fold tomorrow after it gets investigated for fraud or something. Burry's predictions about the market are always worth hearing, and while I wouldn't trade solely based on his advice, it can make as a useful jumping off point for further research into individual stocks. Don't forget to subscribe, and if you found this video valuable, maybe share it with a friend, and I'll see you next time.